Um, we are now being recorded. We will send the slides from today's presentation later, so look for them in your inbox or spam folder. Additionally, this recording will be available on our YouTube channel within the next few days, so be on the lookout for that. SBP is a disaster recovery and resilience nonprofit working to shrink the time between disaster and recovery. As part of that goal, we have partnered with the Walmart Foundation to present webinars focused on educating disaster recovery leaders to fortify people against unnecessary suffering. SBP has 5 innovations: building efficiently, sharing our model with other organizations, preparing home and business owners through resilience training, advising municipal and state officials, and advocating for policy changes and improvements to the disaster recovery industry. We believe in a holistic approach to disasters, increasing resilience before and streamlining recovery after. SBP, in partnership with the Walmart Foundation, is excited to announce that we have 4 webinars left. Our next one will be April 23rd, and it will be with our disaster advisors, Joshua Bright and our Sherry Risk, and they'll speak on best practices in mitigation. The registration link or QR code will be on the slides we send out later today, so you won't have to worry about registering right now. Additionally, thanks to a generous grant from the Walmart Foundation, we have an upcoming event in Savannah, Georgia on April 15th through the 17th. We will host our Incident to Recovery course. It's a 3-day course that equips community leaders and emergency managers with the knowledge and insights to enhance disaster recovery and resilience. By leveraging expert experience, the program helps participants navigate recovery grants and build effective long-term recovery programs for their communities. If you want to attend, please contact me, or you can simply use the link or QR code to register. Following us on LinkedIn and Facebook is one of the simplest ways to stay updated on what the Advise team is up to on social media. We encourage you to connect with us. Now I will pass it over to our disaster advisor, Sherry Risk.
Good morning, everybody. How's it? I hope everybody's doing really well today, wherever you are for today. My name is Sherry Risk. I'm a disaster advisor with SBP. I'm going to go over today. I'm going to go over disaster finance, 2 CFR 200. So 2 CFR 200. This applies to all federal money. And the Federal Office of Management and Budget is the manages the 2 CFR 200. So the CFR is the catalog of Federal Register. It is the how to the laws passed in the U.S. And the CFR 200 is central to the Office of Management and Budget, and it applies to any non-federal entity that receives federal funding. And what does it include? So 2 CFR 200 really outlines for all non-federal entities what their grant agreements look like, what their administrative rules need to be, cost principles, what kind of audits they need to have. It outlines all of these rules when the non-federal entities receive federal funds. So before the federal government awards in any of the agencies, but we're going to talk, this is CDBG-DR today. Before they do that and they award it to a city, county, or state known as a pass-through, before they're doing that, they're looking at the recipients of the federal money, and they're going to be evaluating whether or not the entity has the kind of people, financial people, policy procedures, systems, computer systems, bank accounts, all of that. This is in 206. They're going to be taking a look at that before they award federal funding. They're also going to be looking to see if the entity, the non-federal entity, has policies and procedures in place for fraud, waste, and abuse, and also require that they actually have documentation, checklists, and policy procedures in place to prevent fraud, waste, and abuse. They're also going to be looking to see if the federal government awards to this pass-through, they're going to look and see if there's any conflict of interest. This is all the foundation when monies are awarded to non-federal entities. Before we get started with the rules laid out, we need to think about the distinction between a subrecipient and a contractor, because the treatment of them in 2 CFR 200 is a bit different. So when I speak about subrecipients, think of it like this. They are those entities that are for the public good. Their mission is for the public good. They are going to be making programmatic decisions around the money. So when the federal money is awarded, they're going to make decisions whether or not is it a single family housing program, is it an infrastructure program, is it a public service, and whatever programmatic decisions the subrecipient makes, they have to adhere to what the program requirements are. So if the decision is made to do a single family housing project in an amount not to exceed $200,000, then they have to adhere to that program requirement that would be in policy procedure. A contractor, on the other hand, they have no compliance requirement to the federal government, and they are out to make money. They have goods and services. They provide it to many people. Whoever want to pay their price, they're going to pay that. And they, at the end of the day, they are not required for the federal regulation guidelines. So the pass-through entity is going to be looking at subrecipients, and this could be examples of this could be, you could look at a subrecipient who might provide case management service, inspection services. They might look at environmental reviews. They could have a program by which they have an infrastructure program and they are doing applications to award monies to cities and counties if the pass-through is the state. So before the pass-through, who's the non-federal entity receiving from the feds, before they do that, they have to assess the risk associated with awarding money to subrecipients. And they're going to be looking at past performance. How well have they done? If they've never gotten disaster recovery money, the pass-through, you as the pass-through could be looking at other types of federal money they've gotten. Were they able to spend it? Did they spend it on time? Were there any audits? Did they have any audit findings that may have shown that they didn't have separation of duties or lack of internal controls? In the case of DR, you could see and request, a pass-through may request whether or not they were ever monitored. Are there any monitor findings, any kind of thing there? Also, anytime you award money from the pass-through to a subrecipient agreement, you need to make sure they have financial stability. Do they have a bank account? Are they in good standing? They could have bond ratings, anything like that. If it's a city, county, if it's a nonprofit, do they have stability? Are they able to keep the lights open? Do they have some cash flow going on? And there's stability in that. Do they have an accounting department, computer systems? You've got to look at the quality of the management systems. The management systems being, do they have a financial department? Do they have accounts payable, accounts receivable? Do they have a computer system? Do they hire an outside, maybe accounting firm to do those services for them? You're going to be looking at, the pass-through is going to be looking at their staffing. Are they brand new staff? Have they been around? Have they had staffing in place for, a certain amount of years with a certain amount of experience? Do they have a new computer system that they just got trained up on? You're looking for any stability there or any big substantial state changes in recent time that would lend itself to being a high risk if federal monies were awarded to the subrecipient. All of this review that is in the steps here, all of this has to be documented in an application review. The results of all of the steps above must be documented on how was the risk to the subrecipient reviewed, what was determined, all of those things. In the orange box to the left, you also have to check, as a pass-through entity receiving federal funds, the non-federal entity must check before it awards federal money to see if they've been suspended or debarred, and also whether they, you also cannot award money to subrecipients that are considered the enemy in 215. So the non-federal entity, the pass-through, foundational things to this is receiving federal money. The feds are going to look before the award and see if the pass-through, the non-federal entity, if they have a program design. So they were going to be, so if when they receive the federal money, they're required to design programs. In the case of DR, this could be a single family new construction program. It could be a buyout program, infrastructure program, all of the things that are eligible. They have to have a program design. They've got to make a notice of funding availability. They have to do a notice of funding availability out to that the funding is available, how much, what's the description, who is eligible. They have to publish this so the public can see it. Once applications are pushed out, there also has to be a scoring criteria. That's the merit review process at 205. They have to have a scoring review in the process as they look to award money in the different kinds of programs. So in the case of disaster recovery, if HUD has awarded money to the state has an infrastructure program, the state in turn would design a program. They would do a notice out to all the cities and counties, all the eligible recipients. They would have an application. They would have a scoring process where maybe you get 20 points based on past history or financial stability and all of that. And that is what the diamond steps here are. DR doesn't require match. And the pass-through entities, the states they don't require it. But if it is locally decided that match is something that is required, just from a programmatic design standpoint, 306 is going to define what kinds of items are considered match. So keep in mind, 2 CFR 200 at the level of the Federal Office and Management of Budget is the umbrella, the base. Pass-through entities, those states and counties that receive CDBG DR money from HUD, they can choose to make additional requirements. So although DR doesn't require a match, if the state or county is the pass-through who's received the DR money, they could make requirements to that. And if they do that, they have to look at 306 about what the definitions are of match. Anytime DR money is managed by a pass-through at the state and county level, and they would give a subaward out, they have to identify each of the subawards that they give out through the subrecipient agreement. As a state or county is receiving DR money, and keep in mind in the beginning that the HUD is going to look per 2 CFR 200 and also through the universal notice to see whether the city, or I'm sorry, county or state has the people, process, and systems in place. If it's determined that more staff is needed, or maybe there is a role that the state or county doesn't have, for example, maybe they don't have case managers all year round, and that might be a way that they staff up to manage the DR money. If they do that, then you can also do things like you can also take part of the money received and do a fixed subaward amount. This is in 333 up to $500,000. That doesn't mean that doesn't exclude you from doing the risk assessment, the stair-step slide I did previously. If you do a subaward amount not to be over 500,000, you still have to assess the risk of the entity that you've chosen to do the subaward to. So you have to keep that in mind. There are a few things before the money is funded that you can do. It's known as pre-award. It's in 210. So if HUD is awarding the money, there are certain things that perhaps a pass-through the state or county could do before the money is given. Just keep in mind, a simple rule to this is anything done before you sign a contract with HUD, or if as a pass-through entity you are awarding to subrecipients, the subrecipient needs to look at it in this way as well. Any expenses that you may incur before a contract is signed have to be eligible as if the contract had been assigned. and also justifying and documenting why it's necessary to incur a pre-award cost in order to keep the timeliness of the entire project or grant moving along. So now the money is awarded. So HUD is now awarded to the state and county, or in turn, the state and county has decided or determined to do subrecipients, and they in turn have awarded after this milestone. There is in 2 CFR 200, 201, 308, 309, minimum requirements about what a grant agreement. Now, if you recall, I gave you the definitions. We talked about the definitions of subrecipient versus contract. So right now we're talking about either the pass-through entity from HUD or the pass-through entity and now has done a subrecipient with either with another entity. There has to be particular things within these agreements. It has to be a fixed amount. There has to be a scope. There has to be measurable goals. There has to be goals that can be measured, and think of it in the context of what is being delivered on a timeline. And payments must be based on a specific requirement. So if you're going to pay 20% for a house completion, a single family new construction, or if you're going to pay 20% for infrastructure project, then you would pay 20%. Your payment would be 20% upon 20% completion and subject to an inspection with satisfactory results. That is payment tied to a specific requirement. It has to be fixed. You can't do cost plus a percentage or escalation clauses. You are allowed to modify the performance period. And if you do modifications, you have to go in and amend the grant agreement with an amendment. You need to attach it to the grant agreement. And these revisions include anything from scope, objective, personnel, transfer of funds, changing in any kind of changes in the box to the blue, the basis of what's in the gray, you have to amend the grant agreement. So if the pass-through, the state or county receiving federal, Housing and Urban Development Funds, the DR money, then in turn does a subaward to subrecipients, either through an application process or they're looking at a subrecipient to do, whether it's inspections, case management, environmental reviews, wherever the case might be. This agreement must have the must-haves of scope, budget, timeline, payment terms. There also need to be, if there's any delays, you need to associate damages to it, and you need to have a go, no-go decision. And all these requirements are in 201, 308, and 309. So you want to have the scope to describe at the end of the day, let's say after you pay $200,000, what exactly is going to be delivered per se. And there should be line items for all the different items that you're going to have to pay in order to get that deliverable. That budget and scope should also then be attached to a timeline. And let's say your subrecipient agreement is 2 years, your timeline should encompass 24 months and have phases. Those phases will have key milestones, and the key milestones then will be tied to a payment. You've got to have a failure policy in place, and you got to have a subrecipient. Pass-through entities receiving DR money have 6 years to spend the money from the date that they sign the contract with HUD. The time clock starts. So if the pass-through then in turn has subrecipient agreements that they pass down, you're going to want to have go, no-go decisions. You know, if they're not spending the money in a couple of years, you're going to have to make some tough decisions to pull the money back, because overall, the pass-through, the state or the county are responsible to have the money spent in 6 years. Budget, again, in the subrecipient agreement, you've got to have a budget. It's in 308. A good tip is, if you've got the budget, like let's say it looks like you're outlined like a spreadsheet with things like legal, administrative fee, project management, survey, construction, all of that. When you attach that budget to the subrecipient agreement, just copy over that spreadsheet, that budget template, over into your payment form. That way, when you make your first payment, if there's, let's say, 5 line items in the budget, which then ties back to, in the subrecipient agreement, delivering the scope and the timeline, if you use the same form, in your payment forms, then if you make payment 1, 2, 3, and so on, you can actually pull through all the payments and you can see a trail there where you're documenting all of the different payments. So if it's 5 payments and the line item was $5, you can actually see each individual payment, tie it back to what was originally in the subrecipient agreement. You'll also have dates, and then you can line the dates up with your timeline. So it's a good way to track all of the things to the left about deviations, funds moving from one expense line to the next. It's a good way to track it, and you can have good internal controls that way. Under 208, there are some specific conditions that you may have. I would recommend that may should turn to must. The mays are, you have the ability to withhold a payment until approval is given by the non-federal entity. You can require additional reporting, extra monitoring. You can require that technical assistance has to be deployed from the state or county as the pass-through receiving the HUD funds to the subrecipient. You could require prior approval from the county or the state before the subrecipient even goes out and incurs the expense. All of these things are may, as far as you look at the level of 2 CFR 200.208. But the state or county receiving DR funds can make these must and add additional things. And it's a good practice if you have a subrecipient, when you did the risk assessment on that stair steps, if you think that they're a good risk, but maybe one concern or so, you can make these specific conditions just to protect the project. So in 301, 212, 332, you've got your internal controls. And what 2 CFR 200, 301 states is that anyone receiving federal money, a non-federal entity, when they receive that, they have to have goals and objectives. The goal is to build 50 houses. The objective is to do it in 2 years. If you tie all of that, then it's a good way to document that you've got a good internal control on if you have a certain amount of money received from HUD as a non-federal entity. It's a good way to say these are the stated goals. And then if you met them or not, and you're documenting through payments and you're monitoring it with a timeline, then you've got a very transparent way to show that the objectives were made. And thus you can prove your internal control because you're evaluating it through either your own team's monitoring, or then again, HUD will come and monitor you. As far as public access goes, in 212 and 332, there's personally identified information. So the example would be if John Smith was built a house, you can't divulge, you've got his project folder with his new construction of his house. You can't divulge things like how much John makes, his social security number. These are all protected into CFR 200 as personally identified information. On the flip side of it is when a non-federal entity receives federal money from, when a non-federal entity receives DR money, the state or the counties, or really any non-federal entity receives money, they have to go into the federal transparency system, the FADFA. They have to go in and identify how much money was received, what is the award ID number, what was the money going to be used for. That is true for all non-federal entities. Actually, once their award has happened and the contract is signed, they have to go into this transparency system, and that's in 332. 2 CFR 200-302 sets forth your financial management. So the feds don't require a certain kind of accounting system, cash basis, modified accrual basis. They don't require that. That is up to the non-federal entity, what makes sense for themselves. However, they do require that all records show when money was received and when it was expended. They require that when payments are made, you have to have the source document. So you can't just pay an invoice for $5,000. You can't just pay $5,000 out. You've got to have the invoice that supported that perhaps there were $5,000 worth of shingles bought. You've got to have support and the backup for when you pay money out. And you also have to identify when you receive money at the federal level to the non-federal, when you received it, and actually when you expended it, when you cut the check. So federal payments. The DR money is kept in the Treasury. It is not kept at the non-federal entity. So with that, 305 sets forth drawdown and payment requirements. So when the non-federal entity wants to go ahead and request monies in order so they can turn around and pay contractors and subrecipients and all of the entities that are helping them get this grant accomplished, they do a drawdown to the US Treasury. So when the money comes in, 305 says you've got to minimize the time that the money you've drawn down from the US Treasury is sitting in your bank account at a local level. You also are required to make timely payments. And this is a good practice anyway. If you don't pay on time, you're going to lose contractors in DR. You're not going to get environmental reviews done. Case management's going to lag. So it's in your best interest for the success of your program to make timely payments. But you're not allowed to pay for unsatisfactory work. Now, you might ask yourself, well, why would we do that? But it does happen, and I've seen it happen. You should be looking at the work product that's being delivered. If a new roof is put on, you should have inspectors out. They need to be taking photos, do a write-up, all these kinds of things. You should be documenting all of that before you issue the payment to pay the contractor. Same thing if you hire someone to do an environmental review checklist or case management. You need to make sure that they're offering a good work product before you pay for work. You're not required to put federal money in a separate bank account, but again, because of internal controls, financial responsible, the previous couple of slides, you have to show when you receive the money from the Treasury, like on January 2nd on a Monday, and you've got to show when you obligated it in the DRGR system, when you may have obligated it, and you also have to show in your accounting system when you actually cut the check and expend it. Not only that, you have to show that all of these three things, your bank account, DRGR, and your local accounting system, all of those you have to be able to trace all of those dates to show sort of the whole history of where that money, when it came in, what happened to, along this journey. If you have a DR program where you are generating program income, you need to use your program income first. Let's say you've got bills, invoices and such that maybe it is $1 million drawdown. Let's say you've got program income on hand of $250,000 in your bank account. You would have to use the $250 first, and then you request from the Treasury the $750. You can and must withhold payment if any of the award condition or failure to comply with anything in a contract or a subrecipient agreement. All of these are must-haves. Here is a slide on program income. You can design your programs to where there's possibly a small loan payment or repayment. Also, you may have a situation where you might be doing a project and you may lien it with a deed of trust, failure to comply, and you may have a repayment situation back from a subrecipient agreement to the non-federal, the pass-through at the state or county level. This would be deemed program income, and the rules around that or how you have to, if you have program income, how are you going to use it? It's got to be in a policy procedure. You can use this for match. Once the grant ends, so DR grants are 6 years long. Once the grant is done and you've done the closeouts and all of that, the requirements, if there is still leftover program income in your bank account, there's no requirements around it. So we'll move on to cost principles. This is in subpart E. The approach I take to this is anytime you're incurring costs within CDBG DR funding, the cost principle is you've got to have a basis by which you are going to pay a certain amount of dollars within DR. And think of it like this. The basis is getting an entity who is a third party independent from the non-federal agency, independent from the pass-through, whether that's a state or county. And you can do this through several ways. And the first is you can do a damage assessment. So if you're going to have a single family new construction program and you're going to go out and you've qualified the person through case management and all of the eligibility requirements with DR, you're going to go out and you're going to use an estimator program. You're going to take photos, do a damage assessment, and you're going to input them into the the estimator, the computer program. And it could tell you that if you're going to do fortified roof replacement, you're going to elevate 2 feet above base flood elevation for a house that's 1,000 square feet. It's going to give you a cost in this estimator. That's a basis. That's a third party entity separate from the pass-through that can be used as a basis to document that when you eventually pay for that house to be done, that you've adhered to cost principle subpart E. Another basis that you can use is if you're doing infrastructure programs with DR money, you can do a preliminary engineering report. So a preliminary engineer would go out, they would look at whatever the infrastructure project that you've done in a program design. They would take a look at that and say it's going to be, let's say, $1 million with the engineering stamp. That's also a basis that later, after you've done a sealed bid and procurement, later when you've paid invoices, your cost principle basis evidence, your documentation is the preliminary engineering estimate and that stamp. It's got to have the stamp on it. You can also do, if you're doing buyout programs, if you're doing that, you can say, well, the cost of the house in order to buy it out is a certain amount of money. You could use an independent appraiser. So the appraiser would go out, they would do an appraisal of the house, whatever the cost of the house is, that is your basis. That's your basis to say that I have a principle, I have a cost that is rooted in the principle of a third-party entity that gave me documentation that thus is the basis. It's the basis for justifying the cost. It's the basis for allowability. It's the basis for, to the right, 404, the reasonability of such costs. Once the cost is in hand from the damage assessment, a preliminary engineering report or appraisal, you sit down as the pass-through entity and you take a look at it and say, is this something that a prudent person would pay? Is it higher than what we expected? If the cost estimator said that the house would be $50,000 and now I'm after a sealed bid and I've opened up the bids and the bids are $500,000, I don't think a prudent person would think that that made sense. That's the question you're asking yourself. The next thing you're looking at, as you've got the third-party basis, is this reasonable and ordinary? Are we're redoing a house, we're putting someone back, getting them back in to their house. You're going to take a look at that and say, are all of these things reasonable, ordinary? Do they make sense to get someone back into a house for new construction? You know, you could look at that and say, you know, an example is perhaps a hot tub is not reasonable and not reasonable or necessary. You're going to want to say it's a new construction. It's elevated 2 feet above base flood elevation. It has fortified roof. It has hurricane proof windows. So you're going to definitely, something will stick out as a kind of as a not ordinary as you look through the cost estimate. Is it comparable to what's going on around in your state or county? You can take a look at it on the internet. You know, well, in this county, they pay this, or what I've looked at and researched. Is it comparable? What are the costs for your areas? You know, just think of it like this. As you approach cost principles in this subpart E, not sure why it's E, as you look at this, just say, I have this basis either from an engineer or a damage assessment or a certified appraisal, you know, appraisal who's got a certification in that. Is this comparable to what's around me? What's everybody paying? Is this kind of in the wheelhouse of ordinary? And I just ask yourself, would I pay this myself if I was in this position? Is this something that makes sense for me to pay? All of this, all of the procurement, all of these things I've talked about has to be in a policy procedure. You've got to have it all written out of how the non-federal entity will approach these things. And keeping that in mind as you go through this test, as this swim lane, on the bottom part of the screen, you got to make sure that you follow all those steps in the policy procedure. And you've got to document all of these steps in the cost principle. So the second part of this is cost reasonableness, which is at 404. You've got to ask yourself, whenever the non-federal entity is expending money, is it necessary, reasonable, allowable, and allocable? So is it necessary? Well, if you've got DR funds and people have lost their homes and you're building new homes to put them in, then it's necessary to incur this cost. The reasonableness aspect is the previous slide that we went over with the cost principles. Is it allowable? You will see in the Federal Register from HUD, currently it's the universal notice, whether or not these are allowable expenses. Is it allowable to build new construction? Yes, that's where you'll find it. So you're going to find your allowability in the specific rules of whatever federal agency the program funding is from. In the case of DR, it's going to be in currently the universal notice in the Federal Register. And is it allocable? Can you take the cost and tie it to a specific address, a specific budget line item? Is it allocable? Have you measured it in a certain way? Like think back on the subrecipient agreement. You've got the budget, you've got specific line items to accomplish the construction. So can you track, let's say, a survey cost? When you pay the invoice, can you tie it back through subsequent payment forms? My recommendation is they match the subrecipient agreement budget. Can you tie them all the way back and pull it through to see if you've allocated? Can you trace it back through allocability? This is the reasonableness test. The beginning of it is you've got to have that independent estimate. Again, market prices, software, staff, engineering, you can do it that way. Is it reasonable? If you do a sealed bid, have you gotten more than one bid? No, you have to rebid it. You have to rebid it every single time. You sole source, I have a slide here in a minute that'll talk about that. After all of that, then you're going to do a price or cost analysis and double check. So you've got the third party basis, kind of in the ballpark of what you know it's going to cost. Then you're going to do the sealed bid and you're going to take a look and you're going to start doing comparisons. And then you're going to do a cost or price analysis. And you're going to look at what that is looking at what someone has come back and told you that it's going to cost to put a new roof on, and doing an analysis of that through the bidding, the write-up, the basis, and all of that. That is what a price and cost analysis is. You're going to want to do this for every procurement. You're going to want to do it for every change order. So if you had a cost estimator to build a house for $200,000, and let's say that the sheeting was a square foot of sheeting was $100, and that was what the bid came in. The estimator said it was that. The bid came in as that. Now you've signed the contract. Let's say a change order comes 2 months later. Now the sheeting is $125. By doing the analysis and seeing that delta, that difference increase of $25, you're doing an analysis of, okay, why is this happening? Why is this increasing? So doing this analysis is for every procurement and every change order, and this is your documentation process. This is the process you go through for determining reasonableness. This is all of the backup to the previous slide. There are some factors that outline in 403 for allowability. We've talked about most of these. The big thing here is you've got to document all of this process. You've got to follow your policy procedures. You've got to make sure that the costs are incurred during the approved budget period. That means during the time of your agreements. You've got to look at the invoice date, make sure that it is occurring in the beginning and the ending of your agreements, your subrecipient or your contracts. The allocable costs, you have to make sure that the costs being presented as you pay for it as a non-federal entity are specifically for the award. You've got to make sure that you distribute it proportionately to either the federal grant, or if you are intermingling some of your projects with local municipal funds or other funding sources, you've got to make sure you're tying it back and charging it to the right grant. There are some different special situations on some credits. You can apply credits in certain situations. You've got limitations on some allowances of costs. So even though it's allowable, there are certain kind of costs that might be maxed out. And there are some costs that, I'm sorry, if the cost is deemed unallowable by a single audit or HUD, you have to pay them back. So in DR as a non-federal entity, and when the non-federal entity, the pass-through, awards money out to subrecipients, they can charge a direct cost. I mean, I'm sorry, they can charge an indirect cost. So indirect cost outlaid in 2 CFR 200, it's in 411, 413 to 414, 402, and 407 says, you can charge a de minimis rate, the minimum of 15%. It's approved. You can go ahead and do that. If locally the non-federal entity, state or county receiving direct DR money, if they allow it to the subrecipient, then you can charge it. That just means that if you've got an expense in your budget line item, going back to construction, if you are charging an indirect cost rate, the de minimis rate of 15%, these are things that you cannot tie to a specific address. So it's not direct versus indirect cost isn't a matter of the good or services that's at play here with the project. What the test of it is whether or not you can tie it to an address. So if a cost comes in and you're taking a look at it, if it was for project management or you did the write up on the cost estimate, if that's been subbed out for someone to do the estimate or for the cost to new construction, if you can tie it to an address, then it's direct. If you can't, and the entity is charging an indirect rate for things like the office space rental or copier paper or the electric bill, that's an indirect cost. They can charge for that, but it will be at the de minimis rate. So if their indirect cost in total is $100,000 as a total for their organization, they can't charge you the whole thing, but they are allowed to charge the de minimis rate of 15%. And this too, if the de minimis is, I'm sorry, if the indirect rate is going to be included in the DR, it needs to be a part of the budget sheet that I talked about earlier. So in green are the allowable and disallowable. So 403 to 470 outlines in 2 CFR 200 what is allowable and what is not allowable. And again, it has to be reasonable, necessary. It's got to be consistent and adequately documented and have policy procedures. So all of this is going to have policy procedures. Checklists are very, very good. If you think about from the very beginning of the announcement of the DR to the non-federal entity designing programs and whatnot, to then doing procurement and bidding, getting like, let's say, a single family construction program out, to an application process, to infrastructure. You can think about it all as a whole life cycle and do checklists with that. And that can be your basis as you workflow the human step-by-step process to put in policies, procedures. Then in the policy procedures with checklists, you can go down through it, check. I did, step 2, 3, 4, 5, you can check it. And part of that will all feed into adequately documenting that you went through all of the requirements of 2 CFR 200. To the right are things that are not allowed to be paid with any federal money by a non-federal entity. Things like bad debts, fines, penalties, lobbying, taxes. You can't use federal money as a non-federal entity to then turn around and pay taxes. You are required, a non-federal entity is required in 415 to certify to the best of their knowledge that any reports or any information due to federal funds are true, complete, and accurate, and you will be subject to criminal, civil, and administrative penalties. So now on to procurement, bidding. So in 2 CFR 200, 317 to 319, it outlines the basis for procurement, the reasons why for procurement, the playing field for procurement, all in an effort to promote fair and open competition. In this effort to promote fair and open competition, you've got to be transparent. You've got to give everybody a level playing field to submit a bid. How you do this is you have a clear scope for your project. What are you trying to accomplish with the work that you're putting out there to invite for a bid? You've got to outline what the contract term is going to be, what the timeline is going to be. Is it 2 year? Is it 3 year? You need to do all this because it will inform what an entity is going to submit as a bid. Now, keep in mind, if you've got in construction, if you have got a contractor who wants to do a little write-up for you or do a little general cost estimate, then they won't be able to bid because that's not fair. It's not open. They have a little bit of a leg up, so they can't do that. Also in procurement, you can't do geographic preferences unless you have tribal designation, federal tribal designation. You can't say that I'm going to put a sealed bid out, I'm going to advertise it, and only people from a certain county can bid on it. You have to have procurement policy procedures, and you've got to document. You also need to make your best effort to make the bidding outreach to minority, women, and disadvantaged business entities. Also, in the procurement rules, a good rule of thumb is just avoid anything that looks like, seems like uh, restrictions or elimination. If it doesn't feel fair and open, then you're probably doing something to restrict it. Some of this could be unnecessary excessive bonding, unreasonable requirements that have to be met that nobody could even be met to qualify. Um, you can't specify a brand name. You can't say that a particular brand, like uh, I always use the Kleenex definition, but you can't say in your bid, you are advertising for that or a particular window brand. You can't say you only want that kind. You can do allow or equal to, but you can't call out a specific brand. You can't do anything that is perceived as arbitrary or kind of an off the cuff last minute decisions. So I talked a little bit about price analysis and cost analysis. So think back on the basis, the independent basis. You have a write-up. You're now packaging, asking yourself, is it reasonable? Is it this? Is it that? And you're going to do a bid. When the invitation to bid goes out and you receive the sealed bids, you're going to be looking at the bottom line. So if you've got a cost for a roof replacement and you had 3 bids that came in at, 50, 60, 70, by looking at the lump sum, you're looking at the lump sum price and evaluating it. You're evaluating it back to the estimator program I talked about. You're looking at the market, you're looking at all of that. And by doing all of that, you are doing a price analysis. Good practice would be to have a checklist of some sort, things like that. If you do a cost analysis, you're actually looking at the individual line items. So you'd be looking at the sheeting, the shingles, the fascia. You would be looking at the individual line items. Where this is going to come into play is if you have inadequate price competition, definitely is going to come into play when you have a change order. That's what you're going to look at. If you put it out to bid and then nobody bids and you put it out to bid again and you're still struggling with that competition, you can't get an inadequate price because you're not getting a lot of bids back. That's where the individual costs. By doing this analysis and documenting this all too this is a good thing you just put it in a checklist. You are looking at allowability. You are looking at reasonableness. You are verifying cost data. This whole analysis is all of the information that you've got and you're assessing it. And then by doing that, you're actually documenting allowability and reasonability. There are required in 317 conflict of interest requirements. There's a nice form on HUD Exchange for CDBG-DR. You've got to sign conflict of interest. The pass-through non-federal entities have to sign it. And then if monies are subsequently awarded to subrecipients, contractors, subcontractors, officials that receive it, if you're awarding to cities and counties, have to sign a conflict of interest statement. In 320, it outlines the pricing models. In 2 CFR 200, firm fixed. The paid firm fixed requires a sealed bid in construction. That is outlined in 320. Time and material, the bill labor rate, material amount not to exceed. Tends to be in the professional services type contract. And cost plus percentage of costs and an escalation cost of prizes, these are not allowed. That's why it's in a red circle. So on to bidding. There are thresholds in 320. 2 CFR 200 was updated last year. There is the micro threshold. So anything that you are going out as a non-federal entity that is under $50,000, you don't need to get quotes. You don't need to advertise. I would recommend that you would definitely go out and get pricing and check prices and things like that and document. But 320 doesn't require you to do it. So that's under 50. Small purchase procedure is $50,001 to $249,999. If you are in this realm, if you are in this threshold, you're going to want to get price and rate quotes from different entities, 3 or more. You want to go do that. You don't have to advertise. You do have to document. Email is a great way to, go out and ask for quotes and stuff. And email is a great way to get it documented. These 2 boxes here lend themselves to goods and services type situations. When you start to get into the sealed bid, which is 250,000 and over, this is an advertised bid, legally in the newspaper advertised bid, sealed bid over 250,000. You're looking at construction. I would say too, if you are doing construction type things, maybe it's a demo of some sort and it's under 250, I would still do it as a sealed bid, even though the thresholds are smaller, because the specifications are going to be really good to be specific with outcomes, with goals, and with the scope of exactly what you want to do. And then you can also monitor the costs through the budgets. So sealed bid is sealed bid, 2 or more. That's a firm fixed price contract, and it is based on the price of the bidder, low bid. And you have to publicly do the bid opening and you have to advertise. I will say this, you've got to check your local county and state laws. If they're more restrictive, you got to check for that, because it does depend on where you are in the US as to any other additional type things or any other lower thresholds. I also want to note that if you are doing non-constructive, non-construction professional services, you would do a request for qualifications, and you would be doing a review based on qualifications and not price. It wouldn't be a lowest price situation. I will say that through different states, there are specifics around architecture and engineering rules, A&E, so you should check your local state purchasing office. You can get on their website and check and double check the laws there locally. And then there is your sole source. It is the single source, emergency situations, competitive inadequate. You're going to have to do the cost analysis. You're going to have to do a lot of documentation. In my opinion, this is very rare. It's not looked on well for the non-federal to single to sole source. These could be specialty areas such as historical reviews and things like that. There's a lot of documentation that needs to go behind why the decision was made to only pick a sole source. So once all of that has been once all that process has been completed, the non-federal entity now will negotiate a fair contract and price. So with architecture and engineering, you're going to do the cost analysis. You've done it on qualifications, so now you're going to be looking at price. This could also be based on complexity of work. How much is the contract going to have sub awards within it? Here is 327, 339, 340, 341, 342, 333. These are all of the must-have contained within a contract. Also have to include non-compliance and termination. These also too must be included in a contract. For bidding at 326, you are required over 100,000 to have a bid bond. To bid, you have to have a 5% of the price, 100% of the performance, 100% of the payment. Again, check your local laws. They could be more restrictive. If DR monies are used to buy property in excess of 10,000, you've got to have insurance. You have to track it for 2 years. You may require a lien. You have to report annually over 15 years if you have equipment over $10,000. Financial reporting at 328 for DR, for the Kinston DR, it's required to do it quarterly, every 30 days. And then once the 6 years is up, you actually have 120 days to close the grants out. Here's where you're going to do your accomplishments, your goals and objectives, whether they were met or not. You're going to go percent complete to your construction and all of your schedule. You will be monitored by HUD. Monitoring is at 332 and 329 of 2 CFR 200. Non-federal entity, the pass-through, the state and county, they are required to monitor their programs. The onus is on the non-federal entity to monitor themselves, required to submit financial statements and accomplishment. You've got to monitor and then do the test. Are you following all the policy procedures that contained all these requirements in 2 CFR 200? If you're not, you have to train, correct, provide technical assistance. Now the award is complete. The 6 years has passed. Closeout begins. At 334, the closeout of the non-federal entity is required 120 days after the end of the period of performance. This is where adjustments are made. Are you under budget, over budget? All of these things. If you've got equipment, are you disposing of that? Are there people that owe collection amount? Have you had an audit, a monitoring? HUD has come in. Are there any disallowed costs that possibly have to be paid back? At 334 to 338, you are required to retain all the records for the CDBG DR grant 3 years from the date of the 6-year closeout, not from individual projects. It's actually 3 years from the final date of the closeout report. There are some exceptions, litigation, of course, the access, the OIG Office of Inspector General can access it. Again, just be mindful if you've got personally identified information, you want to keep that locked up, or ideally in a system of record, a computer system of record with a lot of restrictions around protecting that. Subpart F is the audit requirements. Any non-federal entity that receives over $1 million in federal funds is required to do an RFQ and hire a CPA firm to do a single audit. Think about it like this. It's not just the DR money. If the non-federal, if a non-federal entity receives a collection of different kinds of federal funds, it's all everything. It's all federal funds added together if it's over $1 million. Of course, in DR, it's easy to be over the $1 million because of the allocation amounts. But again, you've got to have a single audit. You must have it annually. All of this outlines what the audit is. The auditee is responsible for. They have to arrange it. Again, you've got to procure it. Just like I explained earlier, you also have to procure this. You've got in your procurement with the scope would include being in accordance with all generally accounting principle practices. Audit findings must be, if there are any, you've got to have those noted. You also have to show when things non-compliance, and then there will be a report on the findings and all of the remedies to correct or address the findings. Any audits, again, also have to be retained for 3 years from the closeout of the overall grant. Also, the non-federal entity must reflect its financial position, schedule expenditure awards. There's a CFA form that non-federal entities, a schedule of expenditure financials that the accountants for the non-federal entity fill out to submit to the federal government. Also, the non-federal entity, as well as any subrecipients to the non-federal entity, if there are audit findings, if there has been noted that there is an audit finding, there has to be a game plan for corrective action, and it has to be checked on, checked in frequently. That is required. A management decision must be issued by the independent CPA firm. They have to say why they made that decision, if there's a problem, how it's going to be remedied. So the non-federal entity is reviewed by the federal entity, the U.S. government, and they too are looking at non-federal entities' risk. At 518 to 519, the feds are looking at the non-federal entities, whether it's state or county. They're looking to see, do they have any prior issues? Do they have outstanding DR? Have they had some bad monitorings? Has HUD went in and put them on a, they had some bad monitorings there? How complex is it? Are we giving $1 billion out? All of that is looked at and is required by 2 CFR 200, 518 to 519. All right. I'm going to turn it back to Maria.
Thank you, Sherry. I see some questions in the Q&A box. Sherry, for cost principles, can you use a plan and cost review by a third party to review and document?
Yes, very good question. Yes, you can use a cost allocation plan approved. HUD doesn't do that. Usually you find those from like U.S. Economic Development Authority. They'll review them. You can submit a cost allocation plan to another federal entity and they should review it and they'll have a letter saying, yes, we approve you for, let's say, 24% indirect cost. And that could be used to submit if the state or county with DR funds is allowing, indirect cost as part of their program design. Yes, so you can use a indirect cost allocation plan from another federal agency for an approved percentage.
We have another question here. In the rural areas of our state, the construction companies will upcharge the bids at least 25% more if they know CDBG funds are being used on the project. Oftentimes, there is only one bid submitted due to lack of construction company options. What is the best practice to determine that the bid is reasonable and that they are not upcharging just because it's a federal project?
My recommendation is if you have done the bids and you only get one bid back, you have to rebid. You will have to do that and rebid. If it comes back again and you get another rebid, one of the ways to check the upcharging is if you have a software program that does the estimation, the cost estimator. If you have that, I would check that source. I would also check other jobs of similar nature. And I would work with either the pass-through entity, the state or county, and try to come up with some strategies to get some more contractors to come into the market that you're working.
Okay, and the third question is, do you have any examples of checklists you mentioned would be good in reviewing cost, reasonableness, and allowability?
I have had them. I have used them in the past. I would need, you could reach out maybe with some specifics. But
Okay,
I too, when was a pass through at the state program level, yes, I kept checklists. That way I could assure that all of the steps, on the charts with the cost reasonableness and allowability, that all of those, each step was met and reviewed by my project teams.
awesome.
So you could reach out to Maria and
Okay, we have another question. If the award agreement is between state and a for-profit developer, is the developer required to do a single audit?
if it's over $1 million, yes.
Okay. And we had two other questions and I could actually answer those. We will send out copy of the slides. Just I'll be traveling today, but just look for that by tomorrow, a copy of these slides. And again, if you have any other questions for Sherry, her contact information will be on the slide. So feel free to contact me or Sherry with any other questions that you may have. Thank you all. These are great questions.
Thank you all. I appreciate it. Thank you for your interest.
As a reminder, please join us for our next webinar in April. Don't forget to register to attend our course in April. If you have any questions, do not hesitate to reach out to me about this course. These are just all of our advice offering. If you have any questions about these offerings, please reach out to us. Or you can either visit our resource hub page. Don't forget to follow us on social media. We look forward to meeting with you on future webinars or in person at one of our courses. We will email today's slide deck, as I said earlier, so look out for that in your inbox. Thank you again on behalf of SBP and the Walmart Foundation. Have a great rest of your day.